Welcome to Live at the Nut Bar. It's David Cunningham and I'm actually recording from Squirrel's Nut Bar. So today we've got a very special episode for a couple of reasons. Firstly, we're videoing for the first time and so you better watch this on the likes of YouTube and so on, as well as the audio channels that we use. And secondly, because this is an episode dedicated to first home buyers. The theme of the episode is that this is a Goldilocks time for first home buyers. Not too hot, not too cold, it's just right. So we're going to explore that theme with two very special guests today. Firstly, Emma, welcome Emma.
Thank you.
Who's one of Squirrel's advisors. And secondly, Nick Goodall from Cotality, who, maybe you just explain who Cotality is?
Cotality.
Cotality, there we go.
Yes, it's taking a bit to wrap the name around. New name for CoreLogic.
CoreLogic, yeah.
So yeah, we're a property data analytics company, support the mortgage lending process, in particular with our automated valuation model. So that's a big part that we play.
Brilliant. So when people go online and get a valuation, that's, you're
Often coming
the
from
guys
us.
behind it.
That's
Yeah.
it.
Okay, hey Emma, you've spent a lot of your life actually helping first home buyers get into their own homes. What's that experience like for a first home buyer? Have you got a recent story of someone that you've helped with that's exciting?
I mean, yeah, being in the gig for 9 years, we've seen the highs and lows of the property market. So the Goldilocks, I think that's really true right now. But it's a rewarding job. It's the biggest asset someone really buys in their lifetime, and you're such a big part of it. You have clients say, we rang you before mum and dad because you've been on this journey with us. So it's super special, but it takes a lot of time for the clients and there's a lot involved. So it's
So in the last, I don't know, so far this year, we're about 5-6 months into the year. How many first home buyers would you have helped into their first home?
Gosh, 30?
Roughly?
30? I don't know.
31. Yeah, that's exciting. And what's the mood of the person when they move into their first home? For me, it was like, wow, 30 something years ago. So it's sort of deep, distant memory.
No, it's exciting. Like they're wanting to buy furniture, have their friends around. It's been going for such a long time. A lot of clients, it takes 6 months to a year to secure their home.
Long process. So we'll get a bit into that process later on, but I thought it'd be good to start with this theme of Goldilocks. Not too hot, not too cold, just right. So, hey, let's start with the not too hot, because Nick, if we go back, post-COVID, we had that massive boom in house prices. I'd say the market was too hot then. Can you give us a bit of a sense of, when that was and what was happening in that time? And then maybe Emma, I'll get you to give us a perspective on what it was like for first home buyers in that market that Nick's going to describe.
Yeah, absolutely. I think you think back to COVID and we all thought that the world was going to crash in, and then of course we pumped a lot of money into the market, and that really led to strong growth in property prices. I think the peak growth rate was about 30% in a year, and so that's a crazy level of growth to happen, and that just meant that anyone that was active in that market or trying to buy a property, they were faced with a lot of competition.
So if I was an existing homeowner, my $600,000 house was suddenly worth $800,000. Woo, party! And we all went out and spent and everything like that. But if I was a first home buyer, the price just kept going up and up and up. So Emma, what was it? Did you have first home buyers in that market? What was it like being a first home buyer back then?
Yeah, that was crazy time, Nick? And it was FOMO. Like people were just like cutting corners on due diligence because they're like, I don't have time to do that. I need to get this property.
Yeah. So just FOMO. What's FOMO?
Like fear of missing out.
Fear of
missing
out.
They were just so afraid.
If I don't buy this house, then I'll miss out. If I don't get in today, it will be beyond my reach tomorrow.
Yeah, it was hard out FOMO.
So how did that play out in prices and behaviour that you saw?
Stretching themselves, so they would be borrowing more than 6 times their income in many cases. I think upwards of 30% of all lending done through some of that peak period was above 6 times their income for a first home buyer. So they're really stretching themselves at that time.
But interest rates are really low, weren't they?
That's right.
That is when interest rates got. How low did they get?
Oh, it's like 2.99.
2.99 for 5 years was the low. And we even had nearer
Sometimes
2.
They're coming out of that now. 2.99, 5 years has come into fruition.
So prices were going up, but because interest rates were so low, it felt affordable.
Yeah, that's right. You could borrow so much more, right? Your payments were still relatively low, but you had a heck of a lot of debt. And of course, that's the time when that comes home to roost is when interest rates start to rise again, which I know we'll talk about shortly.
So it was almost like demand exceeded supply. You need to get in today because it will be higher tomorrow, which is, it's a problem with inflation really, isn't it? Buy today because it will be more expensive tomorrow. As a first home buyer, did that mean that people were just constantly missing out?
Constantly.
So you'd get an approval from a bank via an advisor or whatever, you'd put a, go to an open home and want to buy, and then how would it play out, Emma?
Oh, well, people were going to open homes and the front doorway's just full of shoes because every man and his dog is looking for houses, and they'd miss out. And you're dropping a bit of money on your due diligence per property, and that's where we started to see clients become, a little bit, the FOMO was kicking in, and they were like, we don't have time, we just want to buy this property. And they were worried if they didn't get it, it's going to cost an extra 50,000. We were just in a weird bubble. Like, it was a weird time.
So now, what caused that? Bubble's quite a good word. What caused that bubble to, I don't know, burst is the word. It probably is, isn't it?
I think interest rates starting to go up.
Yeah.
So the money supply slowed down.
Yeah, so that was basically inflation had taken off and the Reserve Bank started to raise interest rates.
Yeah, that's exactly right. And I think as well, there was a lot of quantitative easing from the banks done as well. And so there was more money in the system, and that's what was all being paid for. Once that got pulled back, as you said, inflation was high. The Reserve Bank tried to get hold of that inflation by lifting interest rates. And that's when fewer people can obviously afford to borrow the money to keep paying those prices, which we saw through those crazy sort of end of 2021, start of 2022.
So suddenly, people couldn't afford it. All that demand that had been there, that fear of missing out, became something else, fear of
overpaying.
So fear of overpaying, FOOP or something.
Yeah, they called it FOOP.
So we went from FOMO to FOOP. So fear of overpaying. So everyone withdraws from the market. There are a lot fewer buyers. There are sellers still there wanting this price. They're not able to get it. They're not able to get that price, so to sell, they lower it. So, that fear of overpaying, if I buy today, it will be cheaper tomorrow, so I'm not going to buy today. And so how much did prices fall?
That desperation in the market definitely came away. I think transactions fell away significantly. I think our total number of transactions at that low was about 65,000, recognising that we usually average about 100,000 transactions per year. So as you said, the sales just didn't occur because the vendor didn't want to sell and the buyer wasn't necessarily there. In terms of prices, they came down. It varies across the country. I think nationwide about 15% from that peak to the trough. But in places like Auckland and Wellington, it was sort of 20-25%, where values have declined over that couple of year period.
So as prices were falling, how were, Emma, first-home buyers reacting? Were they just staying out of the market and going, hey...
Definitely more cautious.
More cautious, yeah.
And it was also a time where people were a bit worried about their job stability. Like, it was sort of a perfect storm. Yeah. We went from low interest rates, FOMO, to quite the opposite, like quite quickly. It was a really weird
exactly
turn.
What the Reserve Bank was trying to engineer in terms of just dampening demand, or actually killing the economy, some would argue, to get rid of inflation. Anyway, so hey, let's go back to sort of what's been happening over the last year or so. So we sort of had that huge rise in property prices, significant fall, peak to trough. From the start to the... How much did prices rise? Was it close to 50% in total?
No, I don't think it was quite that much. Maybe 40% in some markets,
And dropped by how much?
About 15 on average, but as I said, there's some variability in there too.
Yeah. So we sort of had this big rise, a drop off, and then a bit of sort of sideways and so on. So where's the market? I'm sort of using this terminology just right, not too hot, not too cold. So what's been happening with prices over the last 6 to 12 months?
Yeah, I think if you look at this calendar year, we've seen very little growth, about 0.4% growth or something similar to that.
So that's as good as price stability.
Pretty much. Like, there's very little growth out there. The market seems relatively balanced right now. So we're sort of seeing a little bit more demand, but there's relatively high supply of properties. And so that's just holding back that market, because I think in any other environment, when you'd see interest rates fall at the rate they have more recently, you would expect more demand to come off the back of that. It just hasn't been the case because of the other factors holding it back.
So sort of winding back, what Emma, did interest rates get to? We were up over 7%, is that right?
Yeah, like 6.99.
Yeah, so we're going from sort of 2.99 to sort of 6.99. I mean,
back
wow.
4.89, so it's kind of, it feels that middle of the road.
Yeah, so we're in that sort of almost happy zone of where interest rates have been for a lot of the last 15 years, in that 4 to 5% range at the upper end. So sort of fair, I guess, middle of the road territory.
Yeah, I think you're right in terms of the long-term historical context. It's pretty similar to that time, and so that means that you are getting into somewhat of a normal market. Transactions have lifted. People are back out there buying property.
Yeah, and listening to economists, it's sort of like we're getting near the low in interest rates. Most are saying. So we're at a 3.25% cash rate today. Some economists are saying it could go to 2 and 2.5. The market's sort of pricing, a bit below 3, which is what the Reserve Bank is saying. But we're there or thereabouts. We've had that big fall after that previous rise. So Goldilocks time, interest rates are pretty stable and have come down a couple of percent or more from the peak. prices are stable. Well, what else is sort of making it a sort of a Goldilocks time for people in the market for the first time?
There's a lot of stock out
Choice.
there. Yeah,
That's choice for first home buyers. You know, that there's no desperation to go, I better buy this one. You can just go, if I don't get that house, you know what, there's probably one down the road. You know, or it's maybe one I like better, or, you know, if there's one thing about that property you don't like, you don't do due diligence, it hasn't worked, or, you know, you're a bit worried about the roof needing replaced, you just go, you know what, I don't want the drama, something else will come up, or there's something else down the road.
And that's exactly what we're saying. Like, it's a perfect time for first home buyers, especially low deposit borrowers. Place a 15-day offer. Agents are still happy to get an offer, even if it's 15
So I
working
guess
days.
go back to when the market's too hot. You say, I need 15 days to arrive. Finance, you get laughed out of the house.
They probably wouldn't even have presented it to the vendor, but
Yeah.
now an offer's an offer. So it's a sweet spot for those first home buyers.
Yeah,
and
so you've sort of got choice and time to do your due diligence. You know, you're not forced into making a decision. You know, you can do it in an orderly way. If there's something that you don't like, you can look at the next property and the next one. But when you decide you want it, you're not competing with 5 other people. Is that sort of how it's
That's
playing out?
exactly it. And we are saying exactly like you were saying, Nick, if things don't stack up with due diligence, clients are walking away because there's another house on, you know, nearby, which is plan B. So good time to get on the market.
Yeah, and I think also when you think about that stability and interest rates, like I said, maybe a little bit more downward pressure, but not much more. If you go get pre-approved and you're going to go buy a property, you know, you can be pretty comfortable that even if you don't get one in the next month or two, interest rates won't be that different in 3 or 4 months. Whereas you think about that in an increasing interest rate environment, you know, I can get, you know, I can afford 800 grand or whatever it might be at this interest rate. But if interest rates go up a little bit more in the next 6 months, maybe I can't afford that in a year. So you're in that, it's a really difficult time to be buying when interest rates are increasing. We're just not at that point anymore.
We'll come to some of the things first home buyers should be thinking about. But just before that, Nick, different markets, you know, sort of 5 big markets in New Zealand: Auckland, Wellington, Christchurch, Tauranga and Hamilton. So, you know, maybe just a quick flick through those markets. Are they behaving differently? Let's start with maybe Auckland.
Yeah, Auckland's maybe surprising to some because we track how many first home buyers are buying property each month, each quarter, each year. And first home buyers have been relatively strong. Around about a quarter of all purchases go to first home buyers. And even in Auckland, it's quite high, which surprises some people because obviously the average price here in Auckland is much higher than the rest of the country. But first home buyers do have quite a lot of choice in terms of property type in Auckland.
Yeah.
And so their share at just above 25% is actually pretty consistent because they can buy townhouses. They've got, you know, decent-ish transport, so they can live a bit further from town and maybe not have to go to town for work all the time as well. So Auckland's around about that 26%.
And the average house price in Auckland for a first home buyer is...
Yeah, they're paying about 900,000.
Right. So just wind back a little bit. If we do the maths on, if 900,000, you might be borrowing 800,000. If you're 90% leverage, maybe, you know, low deposit sort of thing. So 800,000, 2% lower, that's $16,000 less interest a year.
Yeah, exactly.
Than that peak. So that's why we're seeing a lot more first home buyer activity, because actually it's more affordable.
That's right. Yeah, I mean, our recent first home buyer report that we put out, we looked at exactly that and said for what first home buyers are buying and the interest rate today, many of them are saving $800 a month in their mortgage payments, or $1,000 a month in Auckland. And that's just due to those that say the same value price of property they're picking up, but just that couple of percentage points interest rate drop.
Makes big difference.
Because things were really tough going back a year or two, you know, just the affordability. But, you know, when you're, you know,
7% interest.
Yeah, so if you're a home buyer too, you know, first home buyer, you know, 18 months ago when interest rates were 7, and if your interest rates were a price, you know, if you could afford that, you're actually feeling pretty good about life now.
Yeah, exactly.
Because the banks were stress testing at 9%. So to get a mortgage over the line was really hard, whereas those test rates have come down.
So what about Wellington? How's the Wellington market tracking? What's it like for first home buyers down there, Nick?
Yeah, Wellington is one of the strongest first home buyer markets in the country.
Oh, hasn't it all been doom and gloom down Wellington? Or is that the perfect condition for a first home buyer when everyone's gloomy?
As long as you're comfortable in your job and you're not worried about losing money, then of course, you know, if you're ready to buy a property, you can find a property you like and you're comfortable, your job is secure and you're not going to, you know, have any change in that income, then yes, it's not a bad time to buy. Particularly in Wellington, it's the sort of outer cities, Lower Hutt, Porirua, Upper Hutt, really strong first home buyer markets. Once again, decent-ish train transport to get into town if you do work in Wellington City. And there's lots of options out there too. Lower Hutt's been a bit of a boom of townhouses too, which are pretty much perfect for first home buyers.
So prices fell almost 25% from their peak in Wellington, you know, government sort of downsizing as part of that, I guess. Have they stabilised?
Yes, they have. They've started to slowly increase again, and it does differ by the different cities within Wellington. But we are seeing that growth come back again, despite the fact there's still a bit of job uncertainty, government's still not spending. But I think we've got to it's a much more normal market. And I was looking at a chart earlier which showed that if you just took out the massive increase and the big decline and then just draw a line from where we're at today to where we were at before COVID in 2019, you'd pretty much be where we're at now. So we've kind of got back to a normal market, normal level of the market where we might have been had the pandemic, had low interest rates, had all that monetary policy, flowed through. We might actually be where we would have been anyway.
Yeah, just a little sidebar here. Actually, our Wellington team had a record best month in May for about 4 years, actually. And remembering that's at a time when property prices are 25% lower, so we're really seeing that activity. And yeah, a lot of it is first home buyers, as you say. Christchurch?
Yeah, Christchurch, one of the more affordable main centres, much lower price than Wellington, than Auckland, than Tauranga as well. And so their first home buyer activity is up around the same as Auckland, around 26, 27%. And again, you've got a range of different properties that you can buy, but the rebuild has really enabled more residential development in places where people actually want to live. And there's different types of property that you can get to. So another strong market.
And Tauranga, Hamilton, pretty big markets.
Tauranga, much lower. And Tauranga is a really interesting one. I suppose it is known as having a higher average age. And Tauranga, more retirees. It's a harder place to buy a property for a first home buyer, typically because someone living in Tauranga is generally, being able to pay that price based on equity built up over a number of years, not based on their current income. So you might not earn as much income in Tauranga these days because you're more older population, but it just has kept those prices high, which means it is difficult for first home buyers to get in. So I think their shares, first home buyer share in Tauranga is around about 17 or 18%, so much lower. Hamilton's similar to the other main centres, Dunedin the same too, so I think we still see pretty strong first home buyer markets across those other ones as well.
Yeah, okay. Just think about new builds versus buying an existing house. What are first home buyers looking for, Emma? Is it existing houses, do-ups and all that?
I feel like it's gone more back to existing homes. The new build, probably when we're talking about that FOMO, I saw a lot of clients get a little bit disillusioned with buying a property missing out at auction, so they turned to the turnkey option to have sort of that certainty.
So they've contracted with the builder directly, so they're not competing. So it might be a subdivision and they're getting that house that's going to be ready in 18 months' time or whatever.
But it was a done deal instead of continuing to miss out.
So that's interesting. So we're seeing first home buyers turn more to the existing
That's what I'm saying, more existing established homes.
Yeah. And prices do tend to be a bit cheaper, Nick, for existing than new homes. I mean, obviously you're getting a brand new home, which is nice, but what's the difference in price between a new build and an existing?
Yeah, I haven't actually looked at the difference recently, to be honest, but yeah, there is generally that discount for existing property. As you said, it's going to be different with maintenance and quality. Exactly.
Used cars sort of thing.
Yeah,
it's cheaper,
that's right.
Yeah. So it's lovely to get a new build, but the price is higher, so first home buyers are gravitating towards. And are they do-ups, Emma, or people prefer to be buying, the house that's ready and that's had its work?
You get a real mixed bag, especially if you've got a couple where he's a chippy. They kind of want to do up to be able to stamp their own mark on it, get some good capital gains. And then you get a young professional couple that are like, we do not want to spend our weekends at Mitre 10. So real mixed bag, but I would say as a general sort of trend, going more towards the established home. And people kind of want to get in instead of waiting 6 months to a year, lock in a nice low rate.
And Emma, do you find that first home buyers today are focused on the home to then have their family in? So they're not buying a house with 1 bedroom or townhouse, they're trying to and able to buy a home with 2-3 bedrooms and a backyard sort of thing?
No, it's a real good question, and I think a trend that's been coming through now that the market there's a lot of supply out there, it's more stable. We are seeing clients stretch themselves more for a home that they're not going to outgrow, whereas when it was FOMO, it's like, I don't care if it's only 1 bedroom.
It was just, I've got to get on the ladder. Yeah. Now actually you can get on the ladder and get the first rung on the ladder actually as well. Or second rung, I suppose you'd sort of say, so people are going straight to the second rung on the ladder.
Definitely. They're like, if I'm going to do the exercise, I may as well do it while the market is the way it is, which I think is great.
Yeah.
Otherwise you outgrow the home once you've got 2 kids and the upside.
Who's going into townhouses then? Because developers have built a mighty lot of townhouses, especially Auckland and Christchurch. Who's buying them?
First home buyers are still buying townhouses too. I think, from our recent report, we saw about 75% of all first home buyer purchases were single standalone houses. So that is definitely the preference, like you said, hopefully the backyard and whatnot. But there's still, 20-odd%, I think it was almost 20% of townhouses. And especially when you look at those markets, like you said, Auckland, Wellington, Christchurch, where there are lots of townhouses, lots of option, priced better for a first home buyer to be able to get in. And so that's definitely an option in those cities.
Yeah, so it's another way onto the ladder.
Exactly.
Yeah.
And that's the thing, you should see it as it's a start. You're not going to be there forever.
And how long does a first home buyer actually normally own their first house and then become a second time buyer? Do you have stats on that?
Yeah, it's one we probably need to refresh actually, but I think typically we talk about it's about a 7 or 10 year cycle.
Oh wow.
You'll stay in that first home before you move on. Has changed over time and it will differ per region as well. But yeah, that's typically the cycle we'd see before. Maybe it's just a situation where you've had a change in your family, maybe you've had another kid or you've had your first kid. And that's when you start to look at the other options, or you want to move it to a school zone or something like that. Those things start to become really important.
Okay, so Emma, if I'm a first home buyer, what are maybe the top 5 tips? What do I need to be doing to get in a position to be a first home buyer, and then what do I do, and who do I talk to, and all those sort of things?
Getting your ducks in a row is really good. Talking to an advisor, especially in the over 80% space, because the banks pretty much close their doors there.
So this is where you're borrowing more than 80% of the value of the home. So if it's let's say $800,000 home, 80% of that's $640,000. So if you've got that $160,000 deposit, it's much easier. If you're going above that, you've only got $100,000 deposit, you're called over 80% loan
over
to
80%.
Value. Okay,
But
it's very doable.
It's very doable, and it's a massive chunk of the market that Squirrel serves.
What would you say is the norm for a first home buyer? Is 90% borrowing?
Yeah, I'd say we see a lot of sort of 10 to 15% deposit.
So as a first home buyer, look at the sort of house you're looking at. Let's say, the range is $600,000 to $700,000. Then go, okay, 10% of that is my minimum, absolute minimum. 15%, gets me
a little bit better.
Less borrowing and so on. You're going to pay a slightly higher interest rate, is that right?
You are, yeah. The banks charge like a margin in most cases.
So talk to your advisor, but
deposit
is sort of key. Now, where are people getting their deposits from? What's the strategy for a first home buyer?
Generally, I would say KiwiSaver, a bit of savings, and mum and dad gifting funds. It's sort of across the three.
Okay, so, and I'm interested to know, KiwiSaver, what are you typically seeing? It's couples normally that both have a KiwiSaver? And what sort of dollars are we talking typically
There's
today?
some big KiwiSaver balances out there, and that's often the chunk of the, because it's been compulsory saving.
50,000 or more than that?
Yeah, 50 to 100,000
Okay,
per.
so 50 to 100,000. So if you're a first home buyer potentially out there and you've got combined, you and your partner got 50 to 100,000, that's getting you started. You'll have saved some money probably in a savings account or a Squirrel account or something.
Yeah, and then maybe mum and dad are going to gift 20K to get you.
So how
up a little
common
bit.
is the bank of mum and dad? So little story, I was 25, 27 when I bought my first house, and the bank of mum and dad was alive and kicking back then, just the same way it is now. And I think it was $20,000 that they gifted towards the $140,000 house in Nio. But, and so the same's happening today.
Still happening, yeah. There's often some component. But yeah, I'd say that would be sort of the general, but a KiwiSaver savings, mum and dad. So get your finances sort of semi in order. And even if the banks aren't open for over 80% lending, we can run numbers and give you some really good feedback on, hey, this is what you can service.
So if you come to a mortgage advisor like you, Emma, you'll run some numbers and tell them what's possible based on what they sort of have done, and maybe guide in terms of, well, maybe not today, but it might be 6 months or 12 months down the track, and give them almost a plan for how they can get there, or potentially surprise people and say, ready now, sort of.
Well, there's a lot of people who don't realise how ready they are because of the test rates coming down. So it's nice when you can feel like, hey, this is actually achievable now. The banks aren't open to give you a pre-approval, but you can service $800K of debt. So if you see a $900,000 property that you love, even if it's going to auction, chances are it won't sell, so it'll pass in. 15 working days, finance, lawyer, builder. Go for it, and that's really
so
powerful.
there are some good deals to get, but again,
Definitely.
It's like getting started, understanding what's
doable. and have a good sort of lawyer in the wings and a building inspector.
So how do you find that lawyer or building inspector?
We can recommend good ones for the Auckland area, same with the Wellington team and Christchurch team.
Yeah, so your advisor can typically help guide you. So again, it just comes back to, get the advisor on your side. We've done this 70 times.
Yeah. I don't even know what the number is. But just getting your ducks in a row is probably the best advice.
Yeah. How often do you find that people are surprised that it wasn't as difficult as they thought?
Yeah, quite a lot.
I guess going back when FOMO was the case through and the market was too hot, it was probably harder than people thought. So today is, perfect, sort of feels good time for
Definitely.
Yeah.
And just not having that stress. 15 working days, plenty of time to do your homework, because it's such a big purchase. It's massive.
Nick, if we look at history, property prices sort of was increased, right?
Yep.
When do prices take off again? What are some of the triggers to watch out for when this sort of Goldilocks period for first home buyers arguably might come to an end?
Yeah, I think we're watching out for what's happening in the economy right now.
Yeah.
It has been slow to get going. I think many of the economists now we've been speaking to will be saying that this is going to be a region-led coming out of the recession.
Regional, as in
the smaller regions.
Yeah, and that's driven by
agriculture,
milk payouts.
Exactly. So I think those and anyone that exports as well is actually still doing quite well and is likely to lead us out of this recession. Once that starts happening, I think again you get a more confident buyers because they've got their job. They maybe can even get promotions and pay rises and things like that. So I think it's all that sort of broader economy feeding into that. We don't think that we're going to have the same rates of growth that we have in the past. Now, I'm sure we've said that in the past and it's been wrong, but when you look at the last 40 years, prices have increased by 6 to 7% every year on year for 40 years. We sort of expect that that's going to dial back to maybe something closer to 3 or 4%. There's a number of reasons for that. Our land use is much more open to actually building on these days. Interest rates are obviously significantly different than what they've been 20 or 30 years ago when they were in 15 to 20%. We've also got double household income, so we earn more money, so we can afford to pay more.
So we've gone through
double
this
our income again.
Period of that's driven much higher house price changes. So 3 to 4% is basically not much more than inflation then, is it?
That's right, yeah. And that should be something you should better keep up with. Hopefully you can save at a similar rate. Hopefully your income grows at a similar rate, and that enables you to then borrow more, pay more for property. So that would be kind of a normal, probably perfect market really, is to see just a little bit of growth coming through. Not too much that it's making it harder for first home buyers, but still a little bit there for the current homeowners so that they've seen their equity increase. And
so this sort of nice period for first home buyers is really quite a decent runway ahead of it.
We think so, yeah. I mean, there's always going to be some external shock that we can't see coming and that could change things up. But for now, and expectations around inflation, which then feeds into what happens with interest rates, is all looking pretty moderate for the next few years. So as long as that plays out, the Reserve Bank can hopefully, take their hand off the wheel and let it drive itself without having to be too involved.
Yeah, I remember the former governor of the Reserve Bank, Adrian Orr, when asked after one of the OCR cuts, he said, what's the golden time for a central banker? And he says, when no one's talking about the central banker because, the decisions are done, the economy is nice and, ticking along nicely. They don't need to push interest rates up or down because inflation's under control. Being out of the news is the
slip into the background.
Of course, during Adrian Orr's tenure, he was in the news a mighty lot. Hey, one other thing I wanted to touch on in terms of the wealth creation through owning a house and having a mortgage. One of my views is that the owning a house is the best forced saving mechanism there is because you've got a mortgage and you've got to pay your mortgage down. So Emma, are people setting up their mortgages to pay it off as fast as they can so they build that equity, or how are people setting things up?
That. I would say definitely with rates coming down, having way more chats about accelerated payments because a lot of clients, especially existing clients, are used to paying 7%, refixing on 5%. Keep the repayments
the same. Your payments up.
Yeah, so take 8 years off your mortgage.
Yeah. So a 30-year mortgage could be done in well under 20 if and it's about just getting those payments set. And I guess the other thing is it creates a buffer for the future. Have a child and you can't quite afford the same payments, or you have interest rates go rocketing up, the sort of thing that we've had. So it's a survival sort of tool. It's almost like the money for the rainy day can sit inside the mortgage by just building up that buffer and building a bit of security.
If you've got the discipline to do it.
Okay, hey Emma, have you got a really nice story of a first home buyer that you've helped that just sticks in your mind in terms of where they went from and what they ended up with, just to inspire our listeners?
Thinking of a recent one, They were 90% borrowers, so 10% deposit. They bought in Massey, West Auckland, purchased for $820. We have to get a registered valuation done when you're over 80% geared. That came in $40K shy. So we're starting to say, we have seen a bit of this. So I thought, oh, these poor clients, like, you know, the vendors are never going to make the market. But I sort of said, this is, the registered value has done his best. I even rang him up. Long story short, the vendors wanted to make the market to move on. So they matched the valuation price. So the clients got the property $40K cheaper. They're all of a sudden paying $1,000 for a valuation, money well spent.
Yeah. So that spending
yeah,
$1,000
so there you go,
earned you 40, saved you 40, because they were really prepared to pay that price.
Yeah.
But you know, that's indicative of the market, I guess. There are motivated sellers, and sometimes there are some really good bargains. So that's just not a story of getting the house at a fair price. It's probably getting arguably at a bargain price, though. I guess the valuation.
So
is the
they felt
valuation.
like they got the deal of the century. It was in line with where the registered value I thought the market was. But that was just a good news story where the vendor was willing to meet the market.
Yeah.
So they
you
were
get lots
chuffed.
of hugs from your customers when they're, you know, because it's part of that Kiwi psyche, and many parts of the world too, is, you know, owning your first home is one of the most special things, isn't it? Yeah.
No, it's just, you're part of a pretty big journey for them.
And first home buyers are presumably like really nervous about the process. How do you as an advisor help people through that?
Pretty much in our initial phone call or Zoom, really lay out, like, do it in bite-sized pieces, like getting pre-approved is sort of number one, knowing what you can even do.
Yes, and knowing what the opportunity will be. Yeah.
How much scope of lending you've got. Then the buying piece, which is the most exciting, giving feedback on properties, running IVALs. I love stalking out properties and giving my feedback. And then the mortgage structures, I think breaking it down and sort of tackling it when you're in each of those stages, it's less.
I guess the point is you're the expert, you've done this 1,000+ times, and as a first home buyer, it's the first time. It's so friggin' scary, isn't it? Yeah.
There's a lot involved,
So,
and it's pretty much just giving them the comfort that we're holding your hand through the process, but we'll just look at it in the chapter you're sort of in so that it's not too much to take in.
Yeah. I think Squirrel's got a first home buyer's guide. Is that a good sort of starting place to
Yeah,
get
it's
some
a
of this
great.
advice?
There's a wealth of information in it.
Yeah, so
It's
go
really
online
good.
and download that.
Yeah.
And what's the next step after that? Is that?
Yeah, I think, I mean, for a lot of clients, like we said earlier, they don't actually know that they're probably in a position where they could look to be exploring this now with...
So book a chat with people like you?
Book a chat with an advisor, minimum 10% deposit, 20% is the golden number, but anything in between can be feasible. So just run some numbers.
Yeah, I think the other one, like I always say, is start looking at properties too.
Yeah.
You know, like get really nosy, just go and check them out. Even if you don't have to go and see them, watch them online, and then wait until the sale price comes up, and you get a really good feel for what properties are going to sell for what, and what you might value that's different to other people. Because a house might sell for a lot more than you would pay, but that's because someone's paying for something that's valuable to them, whether it's a view or the location is really important for a school zone. But for a first home buyer, you might be like, we don't need to price all that stuff in. And so, you know, you get a much better feel for what you value compared to the rest of the market. And you only get that from looking at properties, like I say, being a bit nosy, go to a few open homes, you know, actually understand, you know, whether it's busy during the day and all that sort of stuff. And then once you are ready, you've got such experience in the market that you're sorted.
Yeah, get that confidence from doing your own work, doing working with a...
That's really good feedback, and you get a benchmark for where you gauge a property. Even though it spends a lot of your weekend, you're going to open homes, but the more you look at, you know, the standout when it comes, and you really get your own benchmark going.
Like I say, for the big, you know, purchase it is for your life.
Yeah.
You know, investing a little bit extra time, a little bit sooner, probably is time and money well spent.
And it's sort of fun if, you know, there's a gold,
Exactly.
there's a gold at the end of the rainbow, which was, I guess, back to this not too hot, not too cold sort of theme. You know, for a while it was so hot there wasn't necessarily a pot of gold at the end of the rainbow. You know, then we had the, boy, you know, I don't want to overpay. You know, now we're in this environment where there's lots of choice, lots of times on your side. You know, interest rates are much lower, and you know, there's both new and existing houses, ample sort of supply. So, you know, key messages are save hard. You know, focus on talking to an advisor. So contact someone like Emma here at Squirrel, and book a chat, find out what's possible, and you often might be surprised. And if now's not the right time, at least start to research the market, as sort of Nick says. You know, get to understand what prices are, what sort of suburbs you like living in, and so on. And you know, have a plan in terms of getting to that deposit sort of deposit sort of stage. And hey, happy home hunting to everybody. So that's us for another week. We'll look forward to exploring the housing market a bit more in future episodes. Thanks, guys. Thanks for listening to today's podcast. If you have any questions or things you'd like us to talk about in the future, get in touch with us at david@squirrel.co.nz or john@squirrel.co.nz. And please do share this and subscribe anywhere you get your podcasts. The opinions expressed in this podcast are not financial advice or a recommendation of any financial product. Any commentary provided are personal views and are not necessarily representative of the opinions of Squirrel. As always, we recommend seeking professional investment or mortgage advice before taking any action.